So again, this is option view. These are the 30 equities that I can, without any hesitation, say work very well for candidates in terms of candidate selection to start with trading options, as well as the ETFs, these indices, all these different sectors, the commodities, and we'll even scroll down here and look some of the international stuff, EEM, EWZ. These are all really good. They're great introductions to trading options without risking a ton of money. And you'll get to learn how these options operate and behave. All right. So this video lesson, let's talk about IBM. Now, the reason why I want to talk about IBM, it's big blue, right? Big blue chip stock. This is what it looks like. And if I am going to be taking a predominantly bearish approach utilizing options, well, I want to show you in a market that pretty much, if we go all the way back here, I don't know, I don't really want to pick one of the high profile years, 2008, 2011, but I want to show you, we'll just say if we wanted to go 2010, right? I mean, this pretty much stays within a range pretty much the whole year. We could even say right to about here. And then it broke out a little bit, and then it stayed in a very, very narrow range in through the beginning of 2011, and then it began to just break out pretty quickly. So I want to use this time frame, 2010, as an area to say, all right, if I were selecting this underlying vehicle, I want to show you if I am approaching this from a bearish only tone, all right? All of my trades are going to be bearish. I want to show you what happens when the market moves in your favor, when it moves against you, and when it kind of goes nowhere and moves sideways. And again, I will just recap what I feel like maybe I spent a little bit too much time talking about in the last video. Really just is going to revolve around your position sizing, and while you are the one that's in control of your trading account and your trading destiny, if you will, I can only share with you how I trade. And when I take a directional trade, when I am going to say put my money on the line and make an opinion, say I think it's going up, I think it's going down, then I will not, and very, very rarely will I adjust before the trade either expires, or it's going to expire either 100% loser or 75, 80, 100% winner. And that's just, those are the facts. And so when you begin over adjusting, and this is just my experience with calendars, they are a great introduction. However, they are not a trade that is favorable for multiple adjustments. The only caveat to that is unless you are prepared to continue adding new money and more margin at every single subsequent adjustment point. And for me, there are just too many other opportunities elsewhere in other methods and other avenues to really start kind of battling and fighting and over analyzing and over adjusting a calendar spread. It's a very simple trade to execute. It's attempt to benefit from time decay or directional move or combination of both. And so my particular approach is, if I'm going to take a directional trade on a calendar method or calendar strategy or calendar system or structure or whatever you want to call it, then I am usually going to take a defined amount of money and say that's all I'm going to risk. I'm not going to adjust it. It's either going to hit my profit or it's going to hit my loss. And so what I want to do is just kind of show you that if we start from the basics, start from the beginning. Here's IBM at the beginning of 2010. If I have just turned on my computer and I said I am going to trade IBM and I think it's all-time topping out, it's hit this high dating back here to 2002, I don't know if that's the all-time high or not, but we'll just say it's the all-time high prior 10 years. And this is the market that I am trading, and I am saying I am approaching this with a bearish tone. Then I will say, all right, well, front month equal or greater than the back month. Skew doesn't change. Calendars, you want this front month to be equal or greater than the back month. And if I am going to say this is a bearish trade, well, I've got 45 days to expiration. Where is volatility at in relationship to the prior year? It's on the lower end. So I may want to wait until we get a little bit closer to that 30-day to expiration mark to start looking to enter trades. I can absolutely wait for an up day. I can wait for a down day. I can just say I'm going in at Wednesday at the close. It doesn't really matter, when you enter. What matters is your assumptions in your approach at the beginning. So let me just say, if IBM is at 130, here's the price. Get rid of volatility, and I'm going to target 125. All right, that's one strike out of the money. I'm going to go in the puts because remember, if I'm trading a directional trade, I want to lean into the side of the directional move. Puts, purchase of a put wants it to go down. Purchase of a call wants it to go up. Excuse me. And when you start selling combinations of the two, well, that's the profile you get. It's directional. It's delta negative. We want a move to the downside. Now, we've got 38 days in which to be wrong. We are risking $160. So I will say I convert this trade. And let's get rid of all those, let's get rid of all the dominoes that we had in the last lesson. And I'm going to show you just one adjustment that you can use and why that changed the reports menu. We talked about that in the last video lesson. So this is the approach, right? I'm risking 160. The most I have potential to make is going to be right around 230. That can fluctuate with changes or decreases in volatility. You see it can, it can elevate, it can decrease, but we'll just leave it at 0 for the moment. And we will say that's our trade. So I give my trade allocation an A, and I say we're off to the races. Now, I may say I'm not going to do anything to this for a week. Most I'm going to lose is $160. I am now up $45. If I've accepted the fact at the beginning, I'm prepared to lose 160. Okay, well, do I want to close it now? I've gotten a little bit of a move in my favor, albeit only by a point. Now, we had to endure an up day on the 19th, so I could go back and see what kind of stress that added to the position on the 19th. But again, if $160 is what I have accepted that I'm going to lose, then being down $31 should not bother me a bit. If it bothers you, then change the amount so that it doesn't bother you. If the net margin requirements are such that it's an execute and close type scenario, meaning there's no adjusting, then this shouldn't bother you at all. And that's why majority of options traders maybe look at their trades once a day, maybe twice a day, once in the morning, once at the close. But now you are beginning to see, all right, we had a big move down. We are centered. Now we have created we haven't created it. We are in a delta neutral approach. Delta's pretty flat. We're still positive theta. We're still positive vega. But look at what we did. We created that leapfrog effect between February, we skipped over March, and we have April. Now, watch what happens, all right? I intentionally did this for a reason. I buy in this short, and I sell a new long. That trade on its own, independent, is a reverse calendar. You're selling a calendar trade. This is your existing position, so by rolling that trade, what you have done is you have reduced your margin and you have locked in profits, and you have still given yourself ample time in which to be right or wrong. Okay, so I sold $1.57. I have to buy back $2.78. That realizes a loss. As soon as I convert this trade, you're going to see this go negative. But I have sold $4.05. I bought $3.17. This is valued at $5.05. This change will affect the overall P&L. So when I convert, you'll see right away I'm up $188. That is not accurate. And the reason that is not accurate is because we did not allocate for the roll, right? So this was the roll. We have to allocate and reconcile. That's all part of the same trade now. You'll see that 188 still shows up there. Well, what we have to do is we have to go in here and we have to go and define. All right, hang on a second. Is it format? Oh, info. That's it. All right, so gains and losses to include previously realized gains and losses. So now, once we do that, you'll see it brings up this little asterisk, includes previously realized gains and losses. If we uncheck that, it's going to give us the 188. That is the absolute if this was a new position right now. This is including the roll. This is really important if there are those of you that are using option view. And what I talked about at the end of the last video was making sure that you reconcile the same number to the same trade when it gets adjusted. If it doesn't get adjusted, this is a non-issue. This is not an event that you have to even worry about. If you open a trade and then close a trade, you don't have to worry about this. However, if you do make these adjustments, this is important. So now you can see this trade is valued at $67. But this is the magic. This is the beauty. This is the simplicity and the pure elegance of options. I am now in essentially almost a risk-free trade, right? I got to move in my anticipated direction. I have a trade that's profitable by $67. I have removed my margin from 160 now down to about 30, and I am up $67 on my $30 of margin. I will not calculate, and when I talk about returns on margin, the returns I discuss and talk about are returns on maximum margin at any point in time of a trade, and I suggest you do the same because it gives you that false sense of, well, look, I made $70 on $30. Well, no, your trade started out with 160 for margin, and through subsequent adjustments, this is what it's worth. Okay. Now, again, if that were multiple contracts, let's say that it's 10 instead of 1. Oops. 10 instead of 1. All right. And instead of rolling all 10, well, we wanted to further reduce that margin. So we've rolled them all, but now we sell out 5. We close half of our position. Right? It automatically closes and allocates those 5. Now you have created a risk-free position. You have moved your stop to break even. There is no way you will ever lose money on this trade. And the minimum you're going to make is 180 with the potential to make, in excess of 1,000, almost close to 1,500. Again, kind of maybe borderline advanced topic there, but we'll talk more about that in a future video lesson. Just understand that when you make that roll, when you do make this roll, you have to reconcile and allocate that roll, or else the software will not calculate it appropriately. But going forward now, we're delta neutral. We've got really no reason to close this trade unless we maybe say we get down to 120 or 130. Now we've got a fish on the hook. We want to keep it on the hook for as long as possible, so we just go forward another week. So we'll say between 120 and 130. We've got 5 points either direction in which we can stay. We didn't quite hit it. We're approaching it, right? As long as we continue to keep the trade open, we continue to benefit from time decay. We still have a positive theta. Our delta is getting a little too positive at this point, though, and that shows us that we are beginning to slip away from those ideal profit scenario, which is right in the center. All right, so we would go maybe a couple more days. We're still 50 days to expiration, and we can decide, well, do we want to add to this trade? Do we want to close this trade? All kinds of choices you guys get to make. Let's just say, for the sake of the video and the conversation, we have agreed this is going to be a winning trade. I will close it if we get down to 120. All right, I will close it regardless. But it's time to start the next cycle. 45 days to expiration. My volatility's still low, but it's maybe picking up a little bit coming off of the bottom. So maybe I'll wait 5 more days. Let's wait till the following Tuesday. And as long as we haven't hit 120, let's open up a second trade. Same expiration cycle. Now we're up $92. Haven't hit 120. This is the market that we have. We were bearish. It moved in our favor. We have adjusted and created a roll. We've locked in profits. And now it's time to say, well, you know what? I'm going to create trade number 2. And I'm going to use the March-April combo. I will convert that trade. This is the trade. It's a bearish calendar, right? I will convert that trade, but it's a separate trade on its own. So I need to allocate it a different letter, different number. So now you will see that it's showing 0, right? It shows that I have no trades to analyze. I've converted the trade. So now it's going to show me both of these trades. But please understand that I still have to close this original trade when we hit 120. If we do not hit 120, you guys, and we stay right here, look at what we have created. We've created a double calendar that has a wide range of profitability. We are utilizing the profits from the first cycle and adding a second trade on top of that to keep in a trade. All right, so let's just keep going. Let me go through to the following week and see what ends up happening here. And I do hope that you're beginning to see the abilities for these trades that just, really blow some other types of methodologies out of the water. Now, what are we doing here? We're getting back up to 130. I said on this original calendar that was centered at 125, I'd be 120 to 130. I still have to accept the fact that trade number 2 at 120 was a 100% loser if I was managing it by itself. Trade number 1, if we get to 130, I will close that and realize those profits and lock those in for a guaranteed gain. But trade number 2 will still remain open, as there will still be time in which those options may expire. And now what are we doing? We're getting a little bit farther out here. We're not to 130 yet. Nothing really to do. We'll just keep going and see where this ends up taking us. But these are choices that you get to make when your trades are open. Still didn't hit 130. Got close. We're still staying in between that 120, 130 range, and these are getting close to expiring. So we'll go just another week in time. Again, I'm not looking at this intraday. I'm looking at this once a week. I'm saying I have areas identified. I can set myself alerts on a chart. I can say, 130 to 120. Now, we're getting to that point where I need to really consider closing this trade up. If I closed up trade number 1, all right, let's convert that trade. It's saying I have a minus 153 loss. That's not accurate because it's taking into account that roll, right? Trade number two will have a $32 loss, and we have a maximum at risk of $118. So we targeted 120. We're at 125. We still have 10 days to expiration. If 118 was my maximum loss I was prepared to lose, does being down $32 bother me? No, not at all. But remember, trade number one, I locked in a guaranteed $116. And what I want to show you is, had I not done all of this reconciling for each trade, what ends up happening is it jumbles everything together. So it says, well, wait a minute, now what the heck do I have here? I've got to try and decipher. I opened on the 13th, closed on the 22nd, opened the 22nd, closed the 10th. Do you see what happened is it layered and it does not allocate. It gives you your sum total correctly, but it doesn't segregate each individual cycle. So that was the point I was trying to illustrate in the last video. That is should be a little bit more clear now. The Feb April, all right, this was trade number one, and so then what we ended up doing was we said, all right, BB, AA. So when we do that and we look at the reports, what it's done is it said, all right, trade number one was open on the 13th, adjusted on the 22nd, closed on the 10th. It kept everything in one block, in one section. So then now, when I close trade number two, let's go here just to a couple days before expiration, whatever this comes out to be, whatever profit or whatever loss, okay? So we're down $78. So I'll close this trade, and I will do this right here, convert. Now, my trade log, this is trade number two that was open on the 9th, closed on the 17th. Well, now when I look at my reports menu, it clearly delineates between trade one and trade two. Had I not done all of this in this R column, reconciliation column, that would not give me that display. It will still give me the, it will still give me the accurate total, the cumulative sum total, but it won't tell me the individual trade correctly. Okay, so that was, I wanted to illustrate that in the last video lesson, and I couldn't because there were no adjustments that occurred. All right, so let's keep moving forward. What we got? We got 30 days, April, July. Do I want to do that? Probably not, because again, big gap in the month, and we're separating May and June, so we've got basically 4 cycles. We're skipping 2 in the middle. We certainly could, if we wanted to. We could say, well, I want to sell one and I want to buy one, but see, we've got that negative skew. We're less than the back month, and that trade's going to be a pretty expensive trade. It's going to be a $300 trade, because what we're paying for out here is the long for protection is costing us a lot more relative to what the front month is. We'll just go, let's go to the following Wednesday when these get under 30 days to expiration. And now we'll see, we've got the choice. We can go April, May. And we could say, well, if we wanted to select the 125, we could go 125, 125. We're still negative skew, but we've cut our true risk in half by purchasing a much cheaper option for the protection. Still bearish trade at outset, but the true margin is less. And it would be no different if we wanted to come May, July. We could still do that because, a couple reasons. This is closer to having the skew in line, even though we are skipping June altogether. And that's a very viable way to put yourself in a position to trade a calendar that anticipates or prepares for a possible rolling adjustment, where once, let's just convert it. And I don't know if it's going to happen again or not, but we'll just say this is trade number C. And we have created our opinion is bearish. We want the market to move down. If it moves up, it's not going to bother us. The most at risk is $143. So I certainly want to make half of that or more. And if I can create an opportunity to roll and lock in some guaranteed profits, even better. Meanwhile, I don't have to stay wired to a computer for 9.5 hours throughout the day waiting to see what's going to happen, right? We centered our shorts at 125. We're a long way away. We've got 52 days to expiration. There's really nothing to do, you guys, but just wait and watch. So, that's why I'm going through these several days at a time. The daily updates, you can look at these once a day, either in the morning or in the evening, but the reality is if this is position size appropriately, you can have 8 or 10 different underlyings that you scan through in about 10 or 15 minutes, and have areas identified on a chart. All right, did we hit 130? Nope. Did we hit 120? Nope. All right, nothing to do. Next. And I think you see the potential there, because now we're up $28 on 143, and it's essentially moved just a little bit. Hasn't moved much, but it has moved closer to 125 than up here to say 135. So we'll just roll forward another week and see what ends up happening. Again, this is a bearish trade in a sideways ranging market. This market we looked at the beginning of the video for 2010 was pretty sideways for 8 or 9 or 10 months. And in a sideways market, trading a bearish trade that still can make you money at multiple steps along the way, I don't know. You guys can fill in the blanks, connect the dots, make your inferences however you want there. Because again, I'll do one complete video in this course about let's layer trades. Let's layer a bullish, a bearish, and a neutral all at the same time. Let's manage them independently, but have them aggregated together so that if our bearish trade's making money, our bullish trade's losing money, our neutral trade is killing it, making a lot of money, and we take a small loss on one, take a medium gain on another, and take a huge gain on the third. All right? And I hope you'll begin to see that, understanding the premise and the concepts is way more important than me just giving you what I unfortunately see a lot of trading educators give are, here are some rules. Follow these rules and you will be a trader. That's bunk. That is not the case. You have to understand why you're even following your guidelines and your steps and your rules in the first place. Then you can make your own set of rules loosely connected to the guidelines you learned about, and that's when you become a profitable trader. Right? All right, so let's roll that one. Come into here. We'll do the same kind of thing that I showed you before. We need to allocate this roll. This is still part of the same trade. All right, we've locked in our $50. We don't have a $93 loss. We've locked in our $50, and what we have done is we've reduced margin in that process. We can still say that we're in a bearish position, but here's again one of the benefits: get skilled and get your awareness and your understanding of trading ones and twos. And then, so let's say we've now traded 5, and this is our trade now. And we still have a few $100s worth of risk. We don't have 1,000 or whatever it would be at the beginning, 700-800. But now we've got this much at risk, and we say, all right, well, now I'm no longer bearish. I've got profits in the bank. I want to protect them, and I want to say, well, I want to do this. And I want to say, well, I want to sell this one, and I want to maybe move one or even two of them up. And in so doing, you create something that still gives you as wide of a range as possible while changing. You're not so concerned about this expiration graph. You're concerned about your T+0 graph. Again, that's for you to decide if that fits in your wheelhouse or not. Personally speaking, if you are trading multiple contracts, treat them the same as you were treating the singles and say, all right, well, this was still a bearish trade. I've now got profits locked. I can let this go all the way to 140 before I'm even down money. So let me just approach it from that. I've got 59 days. As long as we don't hit 140, well, I should be able to pull out at least $50 worth of trade. Or I'll say, you know what? I want to make at least $30. I'm up 50. I want to make 30. If I can stay in this a couple more weeks and make close to 100, even better. But let the market tell you when to get out. Don't try and make the market go where you want it to go. That won't happen. So you gain another $10 by sticking around a week. We never went anywhere even remotely close. Again, bearish trade in a sideways ranging market, still doing very well. And you even rolled it one time, locking in the gains. And then here we are. We're up $100. You know, I mean, it was a bearish trade. It moved in our favor. Do you close it, or do you say, now I was going to let it get out here because I wanted to keep my $30 worth of profit. Well, now, you know what? We're getting closer to expiration. I want to collect and tighten that noose up a little bit. Now I'm only going to let it get to 130, so that you know, I want to lock in at least $80 or $85 worth of profit. So I'll say the first day that it closes above 130, or the first day it closes below 120, I'm gone. 120 to 130. And that's just a very simple way to approach a market that you have no way of knowing where it's going to go anyway. And so what do? Here we go. We were out above 130. We had this kind of a day. Did it hit 130 on the day before? Nope. Did it hit 130 on this day? Yep, absolutely. So you are now down $42. You gave up $60 worth of profit, being maybe borderline greedy, trying to get more, but you still have 38 days to expiration. So do you close the trade? Do you keep it open? Do you say, all right, well, when I'm in tighten the noose, profit protect mode, now maybe I'm going to watch this a little bit closer, so I will see, look at what happened at the open, right? Again, let me just tell you what my thought process is. You have to understand that this is, you know, this is simulated backtesting environment, but the mindset is still the same. If this is your trade, Tuesday, May 11th at the close, your trade is up $103 on essentially $45 worth of margin. You have no reason to think we're going to have a big gap move up. You're in a bearish trade. You still have your shorts underneath where the market's at, but you have told yourself 130 is my cut loose and run point, because I don't want to let this trade go all the way back to zero. Remember, this trade was adjusted once, and it's already a huge winner in my book, right? Original margin amount was 188, and it's up 103 now. So if you have said, I want to take the chance and I accept the risks of staying in till 130, and you decide not to close, well, all right. So what happens at the open the next morning? That's the point where maybe you need to watch a little bit closer. you've had a gap open, 2-point move, all right? You're getting really close to 130. You're still up your $100 profits. So let's wait another 30 minutes. What's happened? Is there strength in this move? We hit 130. We're still up $83. What are you going to do? Are you going to close it? Are you going to force or will the market to come back down? Are you going to scream at your computer? Are you going to get down on your hands and knees and pray that it rolls down? I mean, you can't control anything other than your risk and how you handle this market. The market's going to do what it's going to do. If you told yourself it hit 130, it hit 130, close your trade. Keep a little bit of profits, accept the fact that, yeah, you know what, I was trying to get more, but didn't work out. Great, I'm still going to keep something. Versus you end up waiting and hoping and wanting it to go back down, then you're going to be back down here. At this point, what's your mindset like at the end of the day? I'll tell you what my mindset has been is pissed. You idiot, how'd you let all that profit get away? Yesterday, this time, you had $100. Why didn't you close it then? So then what do? You add to it, or you get angry, you get emotional. Those are unhealthy and not conducive to long-term consistency. So that's what I want you guys thinking about when you get that profitable trade on the line. One way to manage them and one way to kind of be thinking about, now you've got a 6-point move up in a bearish trade that went bearish in your favor. You got greedy, you wanted it to get a little bit more, and it didn't. It went against you. Now, that being said, there are still 38 days in this trade to come back and potentially return you in excess of $200. So if you're accepting of that risk, well, what happens? I don't know. Let's see. Let's go forward 2 more weeks and decide, say, we're fully going to risk $60 or whatever the margin is after the adjustment. The margin after the adjustment was $43. Oh, so looky there. What did I say? We all know the majority of the time markets range, they break out, they range, they return to a range, they break out again, they range, they break even higher. I mean, it's a two-sided market. There's buyers and sellers. You see it broke out and it continued to range. It could have just easily come back down into this range, but it didn't. Same here. It broke out. It could have just as easily kept going. And if you're accepting of that risk, all right, that trade could have been a $45 loser. It wasn't a $188 loser, was what you put at the beginning, but there was no reason to get angry and upset because you were the one that chose to take that additional risk when it crossed the 130 level. So, all right. I hope that helps. Let's just, what we got, 24 days. So I would say, what do? We go forward another week. Options that we sold for 196, we now have to buy back at 404. Well, we now have to buy back at $1.34. Options we paid 384, they're only worth 301. But you notice these are holding their value, and as these get closer and closer to expiring, these are the ones that are decaying. And the closer we stay to the 125 centered short strike at expiration, the greater the profits will be. And like I said in the last video, the closer you get to expiration, the more pronounced this T+0 line begins to look like this. The more time you have, if that were 67, it would look like this. It would be very, very flat. So again, I'm not trying to belabor the same points over and over again, but I think it's important for you guys to hear why these operate the way they do. And, again, a bearish trade in an environment that had a couple of really strong bullish days but came back within a range, I mean, your trade is, again, it's a huge winner. And if that's layered in on top of some other trades that maybe one is non-directional, one is bullish, one is bearish, for those that do have the ability or the desire to watch this stuff intraday and keep closer tabs on multiple positions. I mean, the when I say 10% a year is ridiculously simple, I truly mean that. But you have to learn how to crawl, and you have to learn how to, stand up and walk before you even start running a race. I mean, and if it takes you months or years to get to that point, you see the potential, I hope, that these offer to you. So, guys, we're at 42 minutes. I'm going to close this one up. Again, I'm trying to get through a whole entire year. Maybe I'll make just one video where I don't I don't kind of ramble and talk about my thoughts as I'm recording, and I just methodically just go through a whole entire year. You know what? Actually, I will do that. I'll do that in the next video. I'll make the next video how you can trade monthlies and weeklies, and I'll do my best to get through, a full year, and I'll do my best to get through about 3 months of trading weeklies, and it'll just be very simple: open and close trades, open and close trades, open and go right to expiration and close it for either a gain or a loss. All right, guys. So thank you so much again for your patience. I hope you're enjoying it, and don't hesitate, as always, to send me some feedback and any statements or comments I make, if they are sparking questions or thoughts. That's what I'm here. I'm here for you guys. All right. Thanks. Bye.